Investment trusts have certain bells and whistles that private investors can use to their advantage. Now, before I explain 3 of those quirks, let's firstly take a step back and explain how investment trusts work. So investment trusts are like funds in that they invest in a basket of underlying assets such as shares, but investment trusts differ from funds in that they are companies listed on the London Stock Exchange. Essentially, there are 2 layers of activity: how much the trust's underlying investments are worth, called the net asset value or NAV, and its share price. When the share price is lower than the NAV per share, this is known as a discount. When the share price rises above NAV, it's trading at a premium. So in this instance, you're paying more than the assets are worth. If an investment trust's in high demand, perhaps on the back of strong performance, it may be trading on a premium. On the other hand, investment trusts that are out of favour will typically trade on a discount. Therefore, when an investment trust trades on a discount, there is the potential to pick up a bargain if that discount falls. Now, for me, it's a case of taking a view on whether you think the prospects for the trust will improve, which could then lower the discount. Income-paying investment trusts have a particular attraction for investors who would like a regular cash flow, because unlike funds, they don't have to distribute all of the income that's generated by their assets every year. They can hold back up to 15% each year, which means they can build up a reserve to bolster dividend payouts in leaner years. Investment trusts are allowed to gear or borrow to invest. This can improve their performance, but it does also mean they tend to be more volatile than funds. Gearing in a rising market magnifies gains for each shareholder, but if the market falls, investors in a geared trust will suffer greater losses per share. Now, if you're feeling particularly confident about the outlook for an investment trust that gears and it performs well, then you could see your returns boosted over the long term.